From Alliance Bernstein, this is the Global Equity Market and Investment Podcast, with insights brought to you by AB's concentrated global equity team.
Hi, I'm Dev Chakrabarty, Chief Investment Officer of the Concentrated Global Growth Strategies here at Alliance Bernstein. I'm joined by Arpita Bavera, Senior Analyst on the strategies as well.
Hello, everyone.
And we are here to give our monthly update in this podcast around what we've been seeing in global markets around the world, how we're positioned. I'll probably just dive straight in. I mean, you'd have to have been really under a rock to see that it's been pretty strong sort of risk-off month. It's been pretty turbulent out there, and I'd say the theme really has been yields, real yields moving, and in the equity market, how you've seen that rotation in the market. When we say rotation, we talk about that rotation away from growth equities, if you will. So tough for stocks as a whole, tough for sort of growth stocks specifically. And I think you definitely saw all major global indices retreat and give some ground in the month, and therefore sort of impacting the quarter as a whole. Why was that? I'd say that, we heard from all of the central banks in the quarter in this period of time, and really sort of towards the end of August, hearing from the Fed, hearing from the ECB. And ultimately sort of what we really see there is that the central banks have a view where investor expectations were somewhat different. And right now, investor expectations have been anchoring around that higher for longer path in terms of rates, if you will. And that's not quite where they were before. Dot plot is sort of reflecting that a bit more. And hence, you ultimately sort of do see a more cautious stance from investors across September. I'd say that all global markets really were challenged, were sort of pulling back, certainly in the US, certainly in terms of tech. Even with Japan, India was sort of one bright spot, if you will, and you certainly saw sort of some of those strong gains that we've had over the course of the year pulling back through the month. I mean, when it comes to Europe, the region that we're sitting in, the valuation still looks pretty good here, but the growth looks a bit less good. That's the backdrop of the index. I would say for the companies that we look at, you see slightly better growth than the index, and still sort of an attractive and not a stretch valuation. Ultimately, the issue, I think, has been for Europe that it is more geared to China, more geared to global growth. And we've certainly done some company-specific meetings around that. So, Arpita, you were on the road with the team in the month. In terms of, tell us about the European meetings that you did. Certainly sort of, those companies, those sectors which are more geared to China. What did you hear?
Definitely. So one of the sectors that's largely geared to China is luxury, and the change in expectations around China have definitely seen luxury take a hit. So the key word across luxury companies this year had been normalization. After 3 years of extraordinary growth, all the companies were talking that growth would normalize, but the question was always the magnitude of the normalization. And at the start of the year, there was a lot of optimism about China reopening and how that would offset some of the slowdown that you'd see in US and Europe. But however, after the initial excitement, the market kind of turned downbeat as investors started to worry about the property concerns around China. We saw July retail sales come out, and those were poor. And even though it improved in August, I think the sentiment around the sector is very poor right now. There are questions around 2024 growth as well. When it comes to the long term, we feel a bit more comfortable. As you said, the team was in Paris. We saw 7 companies across 2 days. One of them was LVMH. We saw the CFO and the IR there. And they seemed very confident about the long-term industry dynamics. They still think the industry can grow high single digit, still continue to view China as a key growth contributor. So I think that's the gap between the short-term and long-term dynamics there.
That makes sense. And look, if I play back something of what you've been hearing, there's been concerns over the course of the year around whether a recession is coming, whether we're going to have a soft landing, pivoting towards a hard landing, and sort of oscillating between those two. I guess in the luxury sector, normalization has almost been a byword. Recession, if you will. Will you have those same growth rates? If the US consumer isn't spending, if the Chinese consumer is struggling because of a property issue that's going on in China. I think sort of, what's really important to play back is that some of this retrenchment is not coming from the companies, is really coming sort of top down from those expectations. And when we do speak to the companies, it does look like sort of the longer term story, the investments they're making and their growth avenue actually sort of looks pretty good. I mean, I guess let's build on sort of that uncertainty in the short term versus a positive midterm story. Is that something you're hearing about from the semis sector as well?
Again, a similar dynamic in semis as well, where in the long term, the structural growth drivers remain unchanged. You have 5G, IoT, AI, all the inefficiencies that will result from the tech sovereignty drive. Those will all continue to result in strong demand for the semis industry. So again, very attractive from a long-term point of view, but more challenging in the near term. What you're seeing right now is that utilization rates across memory, across logic, are very poor, around 70 to 75%, and that's not what you want to see. So there are concerns around the recovery of the end markets. When will smartphone demand recover? When will the broader consumer end market demand recover? And until that recovers, you don't really see the benefits of AI come into play either. And another concern in the semi space is the speculation around US adding additional restrictions on China. Dev, you were in China earlier this month. Could you share what the environment is like?
Yeah, no, absolutely. Look, I think being on the ground in China doing meetings with our team there is super helpful. This is the second time that I've done it, and we did 17 meetings in about 4 days, if you will. We went into mainland China, and I'd feedback something which is, I guess, a recurring theme around our podcast today. The short term, there is not strong sentiment coming on the ground from corporates. Even in the medium term, where you're sort of geared to technology, if you will, there are some clouds in those companies that we met, where in the medium term you're linked to the consumer. There is a lack of visibility right now. The longer term may look good, but just sort of in that kind of setup, still through to sort of 2024, you've seen some negative revisions, if you will. I mean, I think the jury is out in terms of whether history will repeat itself, and clearly sort of, if we think back to some of us were around during the global financial crisis, it took the Chinese government some time to announce all of the stimulus as well. One, lesson that I've learned in terms of investing in global equity markets is that at least in emerging markets, you want to be with the policy cycle. The policy cycle has thus far been piecemeal, not been enough to sort of stimulate investment, not been enough to sort of, keep that GDP momentum going positively and offset those negative revisions. And ultimately, sort of the consumer has been on strike domestically, and not been traveling as much internationally as well. So I think, GDP expectations are probably underpinned at this level. If for nothing else, they've come down quite strongly. On a nominal level, you see better growth out of the US right now than you do in China, and that's not where we thought we would be at the beginning of this year. So I think that's pretty interesting, and that was the feedback as well in terms of animal spirits from Chinese companies were pretty weak right here in the sectors that we look at.
No, I'd echo that. We received similar feedback as well. At the start of the year, the expectation was that the Chinese tourists would return in summer 2023. But when we spoke to companies in Paris earlier this month, the rhetoric has changed, and they don't expect the tourists to return to Europe at least until summer 2024. So, through the rest of 2023 and into 2024, it is likely that the interest rate environment will continue to dampen corporate investing and consumer spending. So in this backdrop, how are we thinking about positioning?
Yeah, no, absolutely. And look, I think for the remainder of the year, this next earnings season that we go into in a few weeks will be critical to hear from companies, specifically in terms of what kind of visibility can they give. Not just what kind of visibility can they give for the remainder of the year, what visibility can they give on 2024? And within 2024, we're really interested in is what kind of top line growth can they deliver, and how does that compare to the top line growth that they have delivered in the past 3 years or the past 5 years? Obviously, there's a sort of COVID lump in there, but really sort of how does that compare? How are companies sort of recovering, and what are their sort of secular drivers of growth? That's important for the US consumer, that's important for European manufacturing, and that's important across sort of emerging markets where you've seen higher growth rates in the past, and post-COVID, you may be struggling to get back there. Look, I would say that, in Europe, the valuation looks appealing, to reiterate, but the growth looks lesser. So I have to sort of offset that and think about how does that compare to the US. I have been incrementally more constructive around the US. I guess, some people will cite a higher valuation. Well, one, that's had a bit of a pullback in September, and two, if you X out or adjust for the amount of tech, then the US doesn't look as expensive. I mean, one of the things I've been saying as I've been on the road in Asia and further afield is that this year has been really a tape that's been driven, and really a market that's been driven by AI, which is one theme, one growth theme. We think there's a real breadth of growth themes out there which we're exposed to, and they haven't been sort of fully recognized this year. So we continue to sort of back a real breadth of growth themes. A number of those, I'd say, are on sale. Clearly, you've seen sort of some pullback in the short term. Where the medium term story looks good, then we continue to sort of look to sort of back those where the valuation is appealing. And I think with that, we'll probably say goodbye for this month, and we'll speak to you again next month.
Thank you.
Thank you.
Thank you for listening to the AllianceBernstein Global Equity Market and Investment Podcast with your hosts, Dev Chakrabarti. Listeners are reminded that the value of an investment can go down as well as up, and investors may not get back the full amount they invested. Past performance does not guarantee future results, and invested capital is at risk. The views expressed in this podcast do not constitute research, investment advice, or trade recommendations, and do not necessarily represent the views of all AB portfolio management teams, and are subject to revision over time. The views expressed in this podcast may change at any time after the date of this publication. AllianceBernstein does not provide tax, legal, or accounting advice. It does not take an investor's personal investment objectives or financial situation into account. Investors should discuss their individual circumstances with appropriate professionals before making any decisions. This information does not constitute investment advice and should not be construed as sales or marketing material, or an offer or solicitation for the purchase or sale of any financial instrument, product, or service sponsored by AB or its affiliates. Finally, references to specific securities are provided solely in the context of the analysis presented and are not to be considered recommendations by AB. AB and its affiliates may have positions in and may effect transactions in the markets, industry sectors, and companies described in this podcast. An investor cannot invest directly in an index, and index results are not indicative of the performance for any specific investment, including an AB fund.